All right, we're recording. Um, so first of all, I'm going to apologize if the video is very short. Number one. Number two. Today's prize action lesson. It was quite unfortunate that we could not do USACAD analysis. Because I was just off today because of my sickness, basically. Uh, yeah. Now, your dollar obviously was bullish. It wanted to see that bullishness off of this level. That and the bullishness eventually came. But then we tried to sell short initially, and I have to admit, I did not really do preliminary analysis, so I think that was an error on my part. Now a bunch of you guys closed out minus few pips up, which is fine. But yeah, I think I'll take the blame for that one, and I'll apologize. And what you want to learn from today's experience, even though I know it's just it's a break even trade or it's a minus 5 pip stop loss, minus 5 pip loss. And next day could be something greater. It could be something more. So whenever you're in situations where you cannot really pay attention to price, or you're gonna get distracted, or you're sick, just like today, where you're not really in tune price, it's usually best to not trade. But now I would have done that again. In my defense, I would have done that, but because I have a team that relies on me. So that was why I had to be on the charts. Otherwise, today would have been a day where I just took the day off and not done anything. And I really hated taking a loss when it was. I could, if I was okay, I could easily prevented that. So, but it's no big. It's just an ego thing. It's not really. It's not really. It's nothing at all. It's just an ego thing. So, my ego is gonna have to learn to deal with. Taking losses once in a while. Now let's get back into you as a cat. I posted on the Discord that I wanted to talk about something to you guys. So I wanted to. This should be that one video where everything makes sense. That video should be this video where everything begins to make sense. So I'll remove all the drawings. I'll take it out to daily, weekly, any time frame. Basically, just something that we can draw on. And there's basically three things I want to talk about in the video today. I want to talk about deferred delivery. I want to talk about free delivery. I want to talk about rebalancing. Now, if you go back to there was this one video I did on IPDA and origins of IPDA and the nature, the true nature of IPDA and how prices form. And this is something I learned from Chris Lurie's insider trading. So Chris Lurie did I think it was a seminar, or yeah, it was a seminar way back 2017, 2016. I don't know. So I watched a Chris Lurie seminar where he talked about interbank price flows, and I'll just summarize very quickly for you guys. So he talked about liquidity basis. Okay, and when there is an order from a client in one bank, just basically an interbank price feed, and that's the way the first market works, and that's the way the prices of things are set. So the price of things can be set on through um, supply and demand factors, and also on interbank delivery algorithm. Okay, so that's IPD. So it's the delivery price feed of the interbank market that is controlled and regulated and set by the central banks, obviously. Sometimes a bunch of things down together. That's why this is an advanced session for those of you guys who are watching this video. So we have something called a liquidity base. So a liquidity base is where price is in a stable flow of liquidity. We might have a client in bank A, okay, coming and decide to come on. We might have a client in bank A coming and decide to want to make a transaction of, let's say, 10 million contracts worth of transaction. Okay, 10 is too small. let's say 1 billion contracts worth of transaction. 100,000 contract is the standard lot size. 10 1 million contract is 10 standard lot sizes. So we're talking about around 100 million or a billion worth of something like that, around that range. That comes into the marketplace. Um, as that comes into the marketplace, due to the demand, the feed starts to be higher. As the fee starts to be higher, other banks will see this higher bidding in the marketplace. And because they do what we call uh, best buy, best offer, sorry, best bid, best offer, something like that. It's called BBO or something. So it's best bid, best offer. So if this bank is offering the US dollar, Canadian dollar at a higher price, okay, and a new client wants to do transaction on that price, right? If the bank B, okay, if bank B or C or D, which is all connected to the interbank price feed. Remember, bank A is also connected to the interbank price feed. Now there's a transaction done on bank A that causes the price feed to shift higher due to the volume of the transaction. Now, if B and C and D does not adjust their price feed in line with the higher bidding of Bank A, if a customer comes to want to do business with them and they offer at lower prices, that customer can then sell at higher prices to the detriment of the banks. So the banks will lose money because they did not update the price feed according to the bid offered by Bank A. So in order to combat this, as Bank A bids higher prices, Bank B bids higher prices, Bank C is going to bid higher prices, Bank D is going to bid higher prices. Now, it's not like it's being done automatically. It's more of the interbank algorithm beats the prices higher. So that way, the banks avoid losing money. Okay? So price moves from a stable flow of liquidity once there's a transaction that is initiated on one end of a price feed, the other price feed picks it up, starts to beat higher, 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 and that is where you get your fair value gap or your liquidity voids, fair value gap, and that in essence is what creates a fair value gap. What I'm teaching right here is something you're not going to learn anywhere else. Okay. ICT also talks about this, but not in depth. So I was able to blend ICT's concept with that of Chris Lurie, and I basically watched a bunch of seminars and arrived at this conclusion. So yeah. Now the difference, something you're gonna get from my lessons, which I think some of you guys are privileged in getting from other people else's, which is not ICT, is the fact that I don't just learn and copy every single thing. There's a lot of things I teach you guys on here that you will never find in an ICT video because I had to learn them and create the concept myself. So I learn to understand and not learn to just know. And that's also the same thing you'll have to do. You've seen the results in the last 2 weeks. Just a bunch of trades I do that you see me post on Instagram and see the entries and stuff like that. I'm able to do all of those trades because of the understanding behind why pressure does something. Now, a bunch of times I'm gonna mess up when my psychology is off. I think that's my biggest weakness. But when my psychology is aligned and when I'm truly, truly aligned with price, like the results I can do is unmatched. Just think about last year going 6 months without taking a loss. So I'm saying that because if you learn how to learn, to truly watch the content to learn and not watch the content to uh just know, learn the whys and why is this happening, and then know how to apply that to a real price action chart. You become unstoppable. I mean, truly, truly, you feel powerful. Anyways, going back into what I was talking about now, I just explained the basis of fair value gaps. So we have a range here and now we have price come back in the range. Then we have a gap. So the gap is caused by the price feed beating higher prices and higher prices and higher prices. So between the candlesticks, let me delete this. Okay. Now between the low here, the high there, and the low here, we have a gap. Okay. Now this is where you want to bring out your notes and take a bunch of notes. This is what we call deferred delivery. Deferred delivery. So what is deferred delivery? Deferred delivery simply means we are going to utilize this price range at a later time. That is deferred delivery. Now, eventually, price will go and then seek out opposing liquidity. It could be an ODI, a bearish order block, but it's going to seek out premium liquidity or a primary. It could be ODI, rejection block, bearish rejection block, bearish order block, bearish value gap, bearish mitigation block. Price is gonna seek that out, and once it's done that, it might start to trade lower. As it starts to trade lower, this then becomes a very important level for us. Again, not a price range, levels. So what are the levels that are important for us in terms of the deferred delivery? This is what we call the premium high. So this is the premium high of the fair value gap. This is the premium high of the fair value gap. This is the discount low of the fair value gap. We have a premium high, we have a discount low of the gap, and then we have true fair value, which is the mean threshold of the gap. Okay. So that's consequent encroachment. That's CE. That's true fair value of a fair value gap. Okay. So a fair value gap in institutional terms is what we call deferred delivery. So meaning at a later time, that will be a very important level for us. Now, as price begins to drop back down into that level, remember we have a void of liquidity here, meaning the prices here was not driven by real supply and demand factors. Okay, it was artificially driven. So this is going to be a level where market making has to be done, if I should put it that way. Okay, so this is essentially just view this as a void. Okay, fair value gaps are technically price voids. As we start to drop back down into the area of the fair delivery, the first trade inside of this is what we call redelivery. Okay, so remember, a fair value gap is called a deferred delivery. The first trade inside of this is what we call redelivery. Now, we don't necessarily need to trade fully and close the entirety of the gap. As long as we can trade into that range, either the premium high or the consequent encouragement, it's enough. Okay, it's enough. But ideally, we would like to see price trade entirely to discount low. But sometimes you might just trade to premium high or the consequent encouragement, and that will be enough for a fill. Now, as we start to then trade back inside the range, it then becomes a rebalanced range, thus creating a balanced price range. Initially, you want to treat this as a void, absence of market making. Okay. As we start to drop back down, we're having transactions going on inside the gap. But now we have only sell side transaction with an absence of buy side. You don't consider this as buy side transaction. Only sell side transaction with an absence of the buy side. As we start to trade, retrace back to the upside, okay, we now have both sell side, buy side. That is a balanced price range. So now you have a balanced price range inside of a fair value gap. So this is deferred delivery, redelivery, rebalancing. Okay, rebalancing. Or if you're bearish, for example, we'll eliminate this. If you're bearish, for example, this is redelivery. Let's say you want to run out equal lows and there's a higher time frame liquidity draw. Let's say it's a fair value gap, a discount array from the higher time frame that you want to see price reach for. As we break below, if we trade back up into this, that is enough to consider this a rebalancing, and we can see possibly sells down. Okay. Ideally, again, just like this, ideally we would like to see price trade to the premium high, but if it trades to the discount low or the consequent encouragement, that is enough for a rebalancing, and then we can continue to the downside. So whenever we see a redelivered fair value gap, we want to see a rebalanced fair value gap, as that creates a balanced price range. All right, so now how do we apply this on a real chart? Now this is where we go into current price action on USD CAD. I'm going to do a very quick breakdown. I already explained why we should run out the highs in USD CAD. So we had the short term here. I don't need to go back and explain the market maker model. I already did that last week and early this week, so we're good. We had equalize here, we had equalize up top. So we ran the eyes through. Excuse me. Alright, so we run through the short term eye. Now, obviously, if we run above this, any retracement, retail will look to buy this as a classic breaking market structure support level to continue to go long. We don't trade that, so we have a gap here. It's a fair value gap. Again, deferred delivery, just like I taught you guys just now. Fair value gap here. That will be a downside draw on liquidity. So that will be a discount array if we're coming from a premium level, which is ODI. We just completed the market maker buy model. Okay, we've completed a higher time frame liquidity target. We can anticipate potential retracement from that level. We have that. Now we're looking for draws to lower time frame on price. We have this. So now I want you to watch very closely. Now you can see obviously we had a failure swing bearishness. If I compare that with DXY, you can see DXY had higher R's, but this had lower R's. So there was underlying weakness on USD CAD. That should tell you a lot about the directional premise of USD CAD. So underlying weakness in USD CAD would have been good contender for a short. So you already have that. Now trading into today's price action, going down into the 15-minute time frame. Now you can see as we were running to the secondary time frame, liquidity target, we created a void or a gap. Remember, deferred delivery. So I'm going to place a line here. The gap starts from the low of this candle. Starts from the high of this candle. We have a gap between this candlestick's high to this candlestick's low. That is the gap. Now, we trade above the gap. It's all good, all fine. We have a run against the rejection blocks of this. So a failure swing, we have a run against rejection blocks, equal lows here, equal lows, equal lows, equal lows. We break down break market structure, late New York session, back into the breaker block, and boom, we sell off. Now, if you watch the breaker block closely, hopefully it's just not questions from this lesson. Now, on the run up to run the short term high, we have a little bit of a liquidity void between this of a gap between this candlestick side, this candlestick low. We extend this out, okay, and this is a redelivery and a rebalancing inside of a breaker block. Now you see it makes sense. I'm enjoying this because there's a lot of things you're learning right now on the call, and you would understand this, but it's really insane. So we run a short semi, we run rejection blocks, even the high, we run through that. Once we break down below, we have a very specific level where we're looking to go short inside of the breaker block. Okay, we have the low, the discount low of the fair value gap. We have the premium high of the fair value gap. If you so try the premium high of the fair value gap, that is the most premium entry level you can get, and boom, price drops down. Now we have an external fair value gap here. We trade down through it. Remember, it's just called redelivery. So we've redelivered inside of this void. Treat this as a void. We've redelivered inside of the void. Now look at what happens London session today. We then rebalance this, just like we did here. We then rebalance the gap. Now, where does this come in at? Okay, optimal trade entry for New York session. Oh, sorry, for London session. We have an optimal trade entry back into a redelivered fair value gap. Okay, we're rebalancing that. We trade up into the premium high of the gap. Boom, we sell short. Sell it rapidly. Okay, so now I'm gonna zoom in very closely. I don't. This is so weird. Okay, let me use that. Now we sell off. Leading up to New York session, we run this liquidity. It's a shallow run of liquidity. Obviously, we're expecting a very deeper run on liquidity. We don't want to see price go up above this. We don't even necessarily want to see price go back into the range because now this is a balanced price range. So there's no point in wanting to see price go back into the range. Okay, so prior to this run up, we have a short to Maya, short to Maya. We have a breaker block, and the breaker block is indicated by the last down candle. That is the range. Prior to the up move is the breaker block. We can take this down to the 5-minute time frame. So because this is a balanced price range, there's no reason why price should get up into this range. We can sell short at the uh, discount low of this. Let's start the discount low, excuse me. Yeah, the discount low of the breaker block or the PMI of the breaker block. So let's say you wait for the absolutely best entry level you can get. You want to sell short at this, your stop goes above this, but that your stop would just be too tight, and eventually it's gonna get so obvious for your broker that you're using. Something's going on. So let's say you use a typical 10 pip stop loss. Okay, typical 10 pip stop loss. Now, leading up to the way prior to the run up on liquidity, you can see we have another gap. We have a little value gap in price. So rather than using this box, I'll just draw lines so you can see this nicely. Now we already know that we're short from here, so there's no point. Now let's wait for the reaction. Boom. So we smack through this gap. This is a redelivered range. Now we're looking for a rebalancing of the price range. So rebalancing simply means if we can get back, trade up into the discount low of this, that is enough. We can trade up into the premium of it or the considered encouragement, but as long as we can trade into the discount low, that is enough for our institutional flow entry drill. For the person who asked on the chat box, I literally don't know your names via Discord usernames. The person was in Lazarus program. I think it's KED something. Institutional floor entry drill simply means an entry of a fair value gap, but you're entering at the low end portion. So if you're looking for a sell, you're going to enter at the low end of the gap. That is institutional floor entry drill. Okay, and obviously if you're looking for a buy, you're going to enter at the premium high of that gap. And so it's just a specific type of entry or execution with fair value gaps where you don't really want to see a complete fill for you to have an entry off of a fair value gap. So that's that. So we're gonna you will be framing something like this. Entry off of this end, and stop loss is gonna be there. Let's just ignore the fact that price drops. Let's say we're looking for around a low resistance liquidity round setup. Okay, just a low resistance liquidity round setup. We're looking for price to trade into discount low for a rebalancing and then continue to sell off. And you can see we trade into that level, right smack into the level. That is enough for a rebalancing of the gap. And then we sell short. We sell short. Now we have a new gap here. Only sell side liquidity offered. We trade up into this. That is enough for our institutional financial drill. Again, we use very specific levels. All right, this came in at the consequent encroachment. So if your idea was framed off of the consequent encroachment of this, boom, you have your cells into the consequent encroachment, your stop goes above the other block. So many opportunities for you to get in sync with market structure and continue to sell off. Now you can see the distribution is very heavy in the fact that we're not fully closing on the gap. And that is one signature price for a very heavy distribution. When we don't fully closing gaps, that is an indication that price is wanting to reach for a level quickly. And you can see the reaction to our daily. So that daily fair value gap would have been your eventual target at London close. So we get into our level. London closes between 4 p.m. GMT to 1800 GMT. So within that price, that time zone is when you want to take profits, and ultimately we smash a target, and you would have been done there. And you would have had an insane risk to reward off of this setup. If you risked 1% and you took partial, you took 50% off at T1, you're doing obviously, almost you're doing 10% of your account in one trade. That is literally a verification off of one trade. But it's very rare to get trade setups like this. But when you get it, it's usually very, very wonderful. So hopefully this video was insightful to you all about fair value gaps. I'll catch you all tomorrow. You guys all have a wonderful night and be safe.